Have you ever found yourself looking at the investment world and um, wondering if there's some kind of hidden lever,
Hmm.
a secret to truly extraordinary profits beyond just chasing headlines or hoping to pick the next hot stock?
Yeah, I think everyone wonders that at some point.
What if the real key isn't about perfectly timing the market or even finding the absolute cheapest shares, but something far more fundamental, something about the companies themselves?
That's precisely the question we're going to, well, really dig into today.
Okay.
We're exploring the investment philosophy of Philip Fisher, a true legend, really, in growth stock investing.
Philip Fisher. Right.
And our insights, they're drawn from a summary of his pretty influential book, Common Stocks and Uncommon Profits.
Got it. Common stocks and uncommon profits. And the core idea then, what are we unpacking?
Well, the main idea here is that, according to Fisher, the true secret to success isn't just in the numbers you see on a spreadsheet.
Okay, not just the financials.
Exactly. It lies squarely in a company's management quality and its enduring future growth potential.
So our mission today is to really understand Fisher's unconventional yet, incredibly powerful strategies.
Strategies that often fly in the face of common market wisdom.
Right. And hopefully guide you, the listener, to becoming a more informed and potentially, well, a far more successful investor. Let's really get into this.
Okay, so Fisher's central argument, it was pretty revolutionary, especially for its time.
How so?
He believed that investment success isn't just about crunching financial data. It's fundamentally about understanding the intrinsic quality.
Quality and the leadership you meant.
Exactly. The leadership that truly defines a company.
Hmm.
He was kind of obsessed with finding businesses with real, sustainable growth engines.
Not just like a one-quarter jump or a fleeting trend.
Precisely. Not just fleeting trends. He wanted something built to last.
And to find those real growth engines, he had this unique research method, didn't he?
Yeah.
Sounds less like finance and more like detective work.
That's a great way to put it. He famously called it the Scuttlebutt approach.
Scuttlebutt.
Yeah, and it's fascinating because it means gathering information about a company from all sorts of sources beyond the usual stuff.
Beyond the standard financial reports that everyone else is looking at.
Right, the ones most analysts are glued to. He wanted more.
So what kind of sources are we talking about?
Well, the real brilliance of Scuttlebutt isn't just what information you gather, but how it forces you to think, like an owner.
Not just a trader flipping stocks.
Exactly. It involved actually talking to a company's customers, their suppliers, even their competitors.
Competitors, really?
Oh, yeah. And even former employees, people who have seen the inside.
Wow. Okay, that's thorough.
And the crucial insight here, the reason why this is so important, is that this is how you uncover the unfiltered truth.
The stuff that doesn't make it into the annual report.
Exactly. The truth about a company's actual operations, its real reputation in the industry, its genuine competitive edge.
Insights that, no spreadsheet or quantitative model alone is ever going to give you.
That's the core of it.
That unfiltered story, that sounds incredibly powerful. But, in today's world, it's all globalized, digital.
Huh.
How do you even start doing that kind of scuttlebutt?
That's a fair point. Fisher relied a lot on phone calls, visits.
Right, face-to-face stuff.
Yeah. But for us now, it translates, right? It might mean deep diving into online forums, really reading employee reviews on sites like Glassdoor.
Okay. Listening to competitor earnings calls, maybe.
Definitely. Or even attending industry conferences if you can, just to listen, to get that candid, unvarnished truth from people on the ground.
So, okay, you've put on your detective hat, you've gathered all this qualitative intelligence. How do you make sense of it all? It sounds like a lot of information.
It can be. And that's where Fisher's brilliant filter comes in, his comprehensive 15-point checklist.
The checklist. I've heard about this.
It's less a casual list and more like a rigorous interrogation of the business.
An interrogation. Okay.
Yeah. This checklist pushes you to take a truly holistic view. You move far beyond just the current profits.
You're looking at future viability.
Exactly. Future viability, the strength of their market position, and even, importantly, the ethical backbone of the leadership.
And when we talk about those 15 points, what kind of questions was Fisher really digging into? Because it's not just superficial stuff, right? He wasn't just ticking boxes.
Oh, absolutely not. It's deep. For instance, when Fisher asked about, say, research and innovation, he wasn't just checking if a company had an R&D department. That's too basic.
Right.
He wanted to know if they were truly anticipating future market needs. Are they solving tomorrow's problems, not just today's?
That kind of foresight, which is probably even more critical now with how fast things change.
Absolutely. Or take management quality.
Yeah.
He wasn't just asking, are they nice people? No. He wanted to know, do they have integrity in their financial reporting?
Yeah.
Do they treat their employees fairly? Do they genuinely put shareholders first?
Because those softer qualities, they're actually foundational.
Foundational to long-term sustainability, he knew that.
So, okay, you've done this incredibly meticulous scuttlebutt. You've put a company through Fisher's rigorous 15-point gauntlet, and you've identified what he'd call an extraordinary company. But then what? What's the next step?
Well, this leads us to his perhaps most powerful, yet often incredibly challenging investment philosophy.
Okay.
Buy right and sit tight.
Buy right and sit tight. It sounds deceptively simple.
Deceptively simple is the perfect way to put it, because it flies in the face of almost everything the market screams at you every single day.
All the noise, the trading.
Exactly. It's about having the conviction to be truly long-term in a market that constantly churns with endless news cycles and that, fear of missing out.
FOMO, yeah.
Fisher's approach demands profound psychological fortitude, real strength.
So it means once you've found that high-quality company, using his method,
just hold on to it for the long term.
It's not just patience then. It's more active than that.
It's about actively ignoring the daily noise, trusting that the fundamental excellence you uncovered through all that hard work.
Right, the scuttlebutt, the checklist.
That it will compound over years. Often, against the tide of popular opinion at any given moment.
Okay, if that's the case, if you're holding long-term based on quality, it really sounds like a company's leadership is maybe the most important piece of that puzzle.
You got it.
Is that where Fisher put the most emphasis?
Without a shadow of a doubt. Fisher's conviction, his core belief, was that a company's leadership is its single most important asset. Period.
More important than the product.
He believed even the best products or services could be utterly ruined by poor management.
Okay.
Which raises an important question for us today, right? How do we as investors actually assess far-sightedness or that innovative spirit just from the outside?
It's tricky.
Yeah. How do you assess that?
Well, he looked for honesty, that farsightedness, and a real innovative spirit. He argued that that kind of leadership allows a company not just to survive difficulties, but to actually thrive.
To truly thrive and grow, even when the economic environment gets really challenging.
That makes perfect sense intuitively, but isn't it incredibly difficult to truly assess, honesty and farsightedness in management just from public information?
It absolutely is difficult, and that's precisely why the scuttlebutt was so critical for him.
It connects back.
It all connects. Public reports only tell part of the story, often the curated part. Fisher looked for consistency between what they said publicly and maybe what he heard privately. How they handled setbacks was huge for him. And crucially, did management prioritize short-term gains, like hitting quarterly numbers, over long-term strategic growth?
So what were the red flags for him then?
A big red flag was management that seemed overly focused on just the next quarter's earnings or the daily stock price.
Instead of reinvesting for the future.
Exactly. Instead of building the business for the long haul.
Okay. So, if it's truly all about outstanding management and this intrinsic quality, it raises a fascinating question for us as investors. Does the share price, that number flashing on the screen all day, does it even matter that much?
That's a great question, because so many people focus on finding cheap stocks, right? Bargain hunting.
Yeah, that's common advice. Buy low.
It is. But Fisher's counter-argument was crystal clear on this. He believed it's not about finding the cheapest stock today.
It's about finding the high-quality company.
Precisely. Finding a high-quality company, almost regardless of its current price, within reason, of course. He actually said something like, a stock bought at a price that seems high, but which is actually reasonable when you really understand the company's prospects, might be way more profitable than a stock that just looks cheap on the surface.
So look past the ticker price today.
Look past the ticker. Emphasize those intrinsic qualities like a strong brand, its market position, its competitive moat. That's what truly determines long-term value.
Okay. And when you've done all that, you've invested in these high-quality companies, you've got the long-term view. Fisher had some pretty firm advice about market volatility, didn't he?
He did. Very firm.
Essentially, don't panic.
That's right. That sums it up well. His perspective was basically, don't let temporary market dips or short-term fluctuations shake you out.
Even if it looks scary on the news.
Especially then. If the fundamental company is still strong, if it still meets Fisher's rigorous criteria,
The 15 points are still checked.
right, then it will provide good returns in the long run. He saw market volatility largely as noise.
Just noise.
Yeah, psychological noise. A test of your conviction, really. Not a
Wow.
signal that you should suddenly abandon a quality investment you spent ages researching.
His confidence came from knowing the business inside out.
Exactly. Not from reacting to the daily headlines.
Okay, so if you're truly sitting tight on these exceptional companies, maybe just a few of them, you might start asking, how many do I actually need?
Good question.
Fisher had a surprising take on diversification, didn't he? It wasn't the usual advice.
No, definitely not. He absolutely challenged the common notion that more diversification is always better.
Which is pretty radical for many investors. We're taught diversification reduces risk.
And it can, but Fisher's point was different. He argued that true risk comes from not understanding what you own. Ignorance is risk.
Okay.
He felt that investing in too many companies, maybe 20, 30, 50, it just dilutes your returns from your best ideas.
And makes it impossible to follow them all properly.
Exactly. You can't possibly do the deep scuttlebutt and 15-point check on dozens of companies effectively.
So if you've done that work rigorously,
Then you've essentially de-risked the individual company to such a degree that owning too many others just waters down your high conviction plays.
so what was his suggested range? Like, roughly?
He suggested an optimal range of maybe 5 to 10 excellent companies. That's sufficient for a well-managed portfolio, in his view.
5 to 10. Wow, that's concentrated.
It is, but it forces discipline and deep understanding.
Okay, so let's try and recap the profound wisdom here from Philip Fisher. It sounds like it's all about deep qualitative research, that scuttlebutt approach.
Right.
Getting your hands dirty.
Then ruthlessly evaluating companies with his 15-point checklist, focusing laser-like on stellar management and intrinsic quality, not just a cheap share price.
Yep, quality first.
Taking that genuinely long-term view with the buy right and sit tight mantra, which is easier said than done.
Much easier said than done.
And finally, practicing sensible, concentrated diversification, not just buying everything.
Focusing your bets on your best ideas.
It's truly about finding and, crucially, holding on to those extraordinary companies that can drive uncommon profits over time.
That's the essence of it. Finding and sticking with extraordinary companies.
And that leaves us with a provocative thought to chew on, maybe.
Let's hear it.
If the real secret to extraordinary returns truly lies in finding and holding these extraordinary companies with such meticulous, deep research, what does that suggest about all the common wisdom we hear? Yeah, the endless trading, the obsession with daily news, the constant chase for the next hot tip.
Right. And maybe even more personally, even after you've done all that diligent, painstaking research, you've followed Fisher's steps. What immense level of conviction and patience must you cultivate to truly sit tight?
Especially when the world around you is constantly shifting, flashing red, and tempting you, urging you to do something, anything else.
That's the real challenge, isn't it? The discipline.
It really is. It's as much about psychology as it is about analysis.